Jenny Brown. Welcome to this week's MFB News. Hope you're all really good. Hope you've had a lovely week since we last caught up. Been quite busy actually. I've been to the Property Investor Show at the Excel on Friday and Saturday this week. Really nice actually to just go and have a good old catch up with loads of landlords and see that actually, despite all the many headwinds that landlords are experiencing, there's still a lot of positivity, a lot of reasons to be feeling good about the PRS, and actually lots of landlords still looking to invest. So it's great to see that not all of you have been totally put off. Now, in terms of what we've got for you today, we're going to have a look at inflation. The news has come out this morning that inflation has come down a little bit quicker than expected. So we're going to talk a bit about that and what's going on there, and then what that means for the future outlook for interest rates. We're then going to be talking about lender pricing changes in response to the recent movements in swap rates. We're going to be digging into a couple of pieces of lending criteria change. And then finally, we're going to be wrapping up this week with talking about the number of properties that are coming to the market from landlords. So how many landlords are actually putting properties for sale on the market? Makes some interesting listening, I can assure you. So let's crack on. Okay, so it's Wednesday morning. The inflation news has come out today that inflation has fallen to 2.6%. I think kind of the general expectation was that we're going to be at 2.7%. So actually things have come in a little bit lower. And this is largely owing to the lower price of fuel at the petrol pumps, essentially. So that's really, really good news. Now, in terms of the Trump tariffs, economists are predicting that the tariffs that are being imposed on China are essentially going to have a deflationary effect on prices in the UK due to weaker demand and cheap products flooding into Britain. So all of this is kind of saying lower inflation. However, the Bank of England have forecast inflation to rise further this year to 3.7%, and are actually saying that it's going to stay above the target 2% figure until 2027. So it feels like we're getting some mixed messages there in terms of things coming down, but also inflation going up. So what is concerning the Bank of England, what's kind of on their minds when they meet at their next meeting in May and make a decision on base rate? So first of all, we need to think about the inflation information we've just talked about. Now, another thing they're going to be thinking about is wages. And actually recent data from the ONS has suggested that UK wages have continued to grow, with average weekly pay increasing by 5.9% for 3 months, leading to February. The growth matches the previous quarter's figures, marking the highest level since April last year. Notably, wages, and this is the key thing here, have outpaced inflation by approximately 3%. And this is largely driven by pay rises for the public sector. In terms of the job market, it's taken a hit, with vacancies falling to 781,000, which is the lowest since the COVID pandemic and below pre-pandemic levels for the first time. Lots, particularly of SMEs, are kind of feeling very concerned about the future in terms of the extra tax that companies are now facing, particularly in relation to the additional NI contributions, and then also more broadly the economic headwinds that we're kind of facing right now. Now, despite wage growth, the unemployment rate remains steady at 4.4%. Experts are suggesting that while the recent rise in the national minimum wage may keep earnings elevated in the short term, economic uncertainties could lead to easing wage pressures. So wages are continuing to perform rather well for now, but actually watch this space. This may take a bit of a turn. So all of this is kind of indicating that actually the MPC have yet again got a very, very difficult job ahead of them. On one hand, they're being told that inflation, we're being told, that inflation is coming down, that we've actually got expecting to see deflation on certain goods because of the tariffs. But on the other hand, actually wage inflation is continuing to perform very, very well. So it's going to be a difficult meeting for these guys in May. However, the markets are certainly still predicting a base rate reduction in May. Depending on who you're talking to, the kind of current consensus is 2 or 3 base rate cuts this year. Now, in terms of how swap rates have been performing in the last week, and what this all kind of means in terms of mortgage rates. So 2-year swaps, for the first time for as long as I can remember, are now lower than 5-year swaps. We've kind of gone back to a normal yield curve. So 2-year swap rates are at 3.794. That's about 0.2% lower than we were one month ago, and about 0.8% lower than they were this time last year. So a big step down in terms of 2-year swap rates. 5-year swaps, 3.79. Again, about 0.2% lower than they were 1 month ago, and around 0.2% lower than they were 1 year ago. But the key point here being is that now 2-year swaps are higher than 5 years. So lots going on. Again, I think there's so much kind of uncertainty, particularly when it comes to Donald Trump. I mean, it's all about making things difficult for people. So actually, I think we're going to have to really kind of watch this space. In the last week, he's obviously changed his position on some of the tariffs. He's given people a kind of stay of execution of 90 days to get their houses in order, but he's also ramped up China's tariffs. And actually, I think I heard a piece of information, which was that if you take, most items in a household, at least some component of that household would have come through China. So actually, this impact is going to be absolutely global in terms of these tariffs. So I think actually for now, great news, inflation has come down. Good news that swap rates are kind of still staying below where they were a month ago, but actually let's just watch this space. Okay, now in terms of lender pricing changes, and as kind of hoped last week, I suppose, we have seen a run of lenders making rate reductions. Their cost of funds has come down by circa 0.2%. So these guys now have a lower cost of funds. They're not greedy, the lenders actually. I know people won't have the impression that they are, but actually they have to make a certain return per pound of lending. So they have, once they're hitting those returns, broadly speaking, they're happy to kind of pass on any difference in terms of their cost. So if their cost of funds comes down by 0.2, you will see lenders start to reprice accordingly. So what's been happening in the lending space? So first of all, we have seen Keystone reduce their rates by up to 0.1%. We've seen West One, these guys have made massive rate cuts, which clearly have got nothing, something to do, but not entirely linked to the decrease in swap rates. Their rates have come down by up to 0.8%. We've seen Lambay make reductions by up to 0.1, Accord by up to 0.15, Zephyr by 0.2. Vida Home Loans have reduced some of their limited edition rates by up to 0.2. Precise have amended their product transfer rates. Their 1-year fixed rates actually went up by 0.2, but their 2- and 5-year rates have been reduced by up to 0.3%. And Molo have made rate reductions of up to 0.2% as well. So for those eagle-eyed amongst you, you're going to notice that the vast majority of lenders that I've just named there are specialist lenders, with the exception of Accord. So actually these guys are the ones who are very exposed to capital markets. As I've talked about in many other episodes, not all lenders are entirely exposed to capital markets. Their funding model is slightly different. So if their cost of funds on the capital markets drop, it's not a binary thing in terms of their pricing. So a bit more complicated for the clearing banks essentially. But good news in terms of the specialist lenders. Now, one of the things that I just wanted to pick up on that I've just mentioned was Precise dropping their product transfer rates. And actually, for all lenders dropping their rates, I suppose more broadly, one of the things that we've been doing is going through our pipeline of mortgage applications, which are product transfers with Precise, to check whether we can now get our clients a more cost-effective rate than the one that they were taking. So that's kind of standard practice at MFB. But likewise, actually, for any of you who have a mortgage offer in the pipeline and the rate was applied for less than a week ago, there's a very strong chance that actually your rate may have come down. So do contact your lender or your broker and ask them to check for you. Now, you may end up paying a small fee for changing rate with the lender. It depends who the lender is and at what stage in the process you are. So some lenders don't charge a fee until you get to mortgage offer. Some lenders will charge a fee no matter what, and some lenders don't charge you anything at any point. But the point is, these fees tend to be quite small comparatively, so sort of £150, those kinds of numbers. And invariably speaking, if your mortgage rate has come down by 0.2%, you're going to be saving more than £150 by moving on to the new lower product. Now, I guess the kind of difficulty here is actually when to ask for this lower rate. So are rates going to come down further? Or actually, have we hit the kind of new bottom, as it were, for the next few months? Only time will see on that one. But particularly if your lender's allowing you to switch rates for free, I'd certainly be picking up the phone and asking those questions if I were you. Okay, now we've got some criteria changes just to run through. And the first one comes from BM Solutions, who have amended their rental calculations. So essentially, now you can borrow more per pound of rental income with these guys than you could do this time last week. On most products, I'd hasten to add. So what they've done is, first of all, if you're doing a purchase or a remortgage where you're capital raising, they have reduced the rental calculation from 5% down to 4.5% on their 5-year fixed rate. So the calculation would be 145% coverage, assuming a notional interest rate of 4.5%. This was 5% previously. And this is on purchases and remortgages where you're doing any sort of capital raising. It also incidentally applies to their further advances as well. Now, if you're looking at a 2-year fixed rate, they haven't changed the rental calculation there. But on like-for-like remortgages, they've changed their rental calculation on both 2 and 5 year fixed rates. So just to recap, a like-for-like remortgage is when you're doing a remortgage to BM Solutions from a totally different lender, and you're borrowing exactly the same amount of money. So because of the kind of guidelines that sit around responsible lending, which is set out by our regulator, the FCA, one of the things that they have said is that actually if a client or a borrower is taking a mortgage and they're not increasing their mortgage debt by any amount at all, even by 1p actually, it has to be literally like for like, then you are able to exercise more flexibility in terms of your rental calculation. So lots of lenders do a like for like calculation. The key thing here is that BM Solutions have reduced theirs down, which is really fantastic. So I think, why is this important? So first of all, it's important because it means you can borrow more per pound of rental income with BM Solutions, which is fantastic. And we know that in times gone by, over the last few years, the rental calculations have been an absolute sticking point for lots of landlords. This is really good. But the other thing is, the BM Solutions are one of the largest buy-to-let lenders in the UK, and if these guys make such a bold criteria change, other lenders certainly take notice and start thinking about what they're offering and whether they can compete. So good job from BM Solutions. Now, the other criteria change that I just wanted to mention, it's not such a criteria change actually, it's just a criteria reminder that came through from one of the lenders that we work with, Molo Finance. Now, Molo are a relatively new kid on the block. They're very good. I wouldn't ever be nervous about using a new lender. They're very tech orientated, so their application process is really quite slick actually. But the thing with Molo is they actually have some really niche pieces of lending criteria. And they sent through a little table, which is quite interesting, saying, here are the things that we do that no other lender does, which I thought were just worth sharing actually, because you never know, maybe one of these might be useful to you guys. So the first thing is with Molo, they have no minimum visa requirements. So if you have a foreign national who's here in the UK working on a visa, Molo can lend to them, okay? They don't have any requirements around that. The second thing is that when they're looking at lending on a flat, which is an ex-local authority block, they don't have a minimum owner-occupier percentage requirement. So what a lot of lenders will say is that we don't mind this block is ex-local authority, but actually at least 50% now needs to be under private ownership, i.e. it can no longer be owned by the local authority. Molo don't have this requirement. So for these guys, it's literally the valuer goes out, and as long as he says it's good for letting and actually there's a resale market for the property, they'll be happy to lend. Now, another thing that they've said is that they accept first-time buyer, first-time landlords for domestic and international clients. So what this means is that actually if you're a first-time buyer, so you've never owned a property before, and I think the key here is international clients, because there are other lenders who'll do buy-to-lets for UK nationals, UK-based, is that actually they could also consider lending to you as well. Obviously, you have to be UK resident, so this really applies to people who are a non-UK national living in the UK, could be on a visa, as we've just mentioned, and actually you're a first-time buyer as well. Molo could be a really good home for you. So I thought because these are quite nichey, they were just worth sharing. Okay, now this is one of those reports that I derive absolutely no pleasure from sharing with you whatsoever, but I do think it's important because this report is really talking about what's going on in terms of landlords selling properties versus landlords buying properties. So this research was compiled by 20EA and part of the 20CI group, and it's its latest property and home mover report. And it found that in the last quarter of 2024, 12.2% of all new instructions were properties that have been rented out in the last 3 years in the private rental sector, which equated to 39,684 homes. I'm going to apologise, by the way, this is quite data heavy, but it's actually really important. So lots and lots of properties came onto the market for sale in the last quarter of 2024, which were previously rented out. Of those sold in quarter four last year, just 2.9% were re-let in the first quarter of 2025, suggesting that 3,634 properties were purchased by other landlords and brought back into the rental market, and the rest were kind of lost from the rental space. Further, 15.6% of newly listed homes in quarter one were formerly rental homes, a higher share than the previous quarter and up on a share of 9.8% in quarter one in 2024. This totaled 70,542 formerly rented homes. The number of homes that have come onto the market in the first quarter of this year is a massive step up from the first quarter in 2024. A 20EA said that with around 50 to 55% of new instructions going on to sell, this could mean around 18,000 homes have left or are leaving the market since quarter four 2024, putting further pressures on supply. This is why I don't like this article, by the way. Okay, so look, alongside this, 20EA found there was a 1% decline in the supply of new to let properties at the start of this year compared to 2024, and this was 22% lower than the pre-pandemic year of 2019. The number of all to let homes dropped to an all-time low at just 284,000 properties available. This was 18% down on Q1 2024 and 23% lower than the pre-pandemic period. Nearly half, 46% of all available rental homes have a rent of more than £1,500 per month. Further 15% are more than £3,000 per month. The average let agree prices is now £1,767 per month, which 20EA have said would be unaffordable for most tenants. So I think what we can really see here is the thing that we all kind of, I think, knew was going to happen, hoped it wouldn't, but it's largely going to happen, is that there are more and more landlords looking to divest, not necessarily entirely, but maybe offload some of those properties which are going to require large amounts of work to bring them up to the EPC levels that are going to be needed in the next couple of years. Some landlords are just disenfranchised, some landlords are changing their strategies. So it's not like all landlords are leaving the buy-to-let market, but certainly landlords are kind of going through a consolidation period, let's call it. And this means there are less rental homes on the market, and this is just continuing to drive up rents. So ultimately, because of all the legislation and the taxation and all of those things that landlords are facing, ultimately the end result of this is that renters are simply going to end up paying more rent, which is not good for those guys who these legislation and tax changes were initially really designed to protect. So not great news there. But what I do think, and I say this often, and this is the kind of sense that I got from the landlord show, and this is a thing that I think is really important to share, is that actually when you kind of think about it, for those landlords who kind of stick it with it and see out these challenging few years, and by this what I mean is the higher mortgage costs, that kind of stuff, the new legislation coming in, actually I genuinely believe that it's going to be worth the wait. So ultimately what we can see is that we're going to be left in a sort of environment where there's going to be less properties to rent. The demand is still going to be there. We know that net migration predicted for the next few years is absolutely huge. People coming to the UK to work don't want to buy their own homes most of the time. Normally they're here for a period of time. They want to just rent something and be able to leave again. These guys, the rental market is going to continue to grow. So actually, for those of you who stick with it, I genuinely think that actually the PRS is still a very good place to be. And that's my 5 pence for the week. Look, thank you as always for watching. It'll be an interesting few weeks, I think, is how I'm kind of seeing things. I'm fairly confident of the base rate reduction in May. It'll be interesting to see what happens with swap rates. I suspect they might ease off a little bit over the next week, but let's just see. And as you know, and we've really illustrated today, that will just mean that lenders will be able to reprice down a little bit further. But let's just watch this space, no promises for sure. Because the one thing we've learned over the last few years is that it's very, very hard to make predictions in a very, very unstable environment. Have the most wonderful Easter. I am going to the Peak District on a walking trip, which I thought was going to be fantastic. It's going to be raining. So yeah, expect lots of whinging next Wednesday from me. But I hope whatever you're up to, I hope it's wonderful, and I hope the sun shines down on you. I will see you same time again next week.